Warren Buffett, the Oracle of Omaha, stands as a towering figure in the world of finance. His decades of unparalleled investment success have made him a subject of intense study and admiration. While his investment decisions are often scrutinized, the underlying principles that guide his strategy remain remarkably consistent and surprisingly simple. Drawing from a discourse where Buffett reflects on his early investment journey and pivotal influences, this video delves into the core tenets of his investment philosophy, expanding on his insights to provide a comprehensive understanding for both novice and seasoned investors. Buffett's investment journey began early, a testament to his innate curiosity about the world of finance. He recounts starting to invest at the age of 11, a delay he playfully laments, wishing he had begun even earlier. His initial foray into the market was marked by experimentation with popular, albeit often fruitless, techniques like stock timing and charting. This period, lasting until he was 19, was characterized by voracious reading of investment books from the public library. While this early exploration lacked a solid framework, it ignited a lifelong passion for understanding businesses and the dynamics of the market. The true turning point in Buffett's investment thinking arrived in 1949 with his encounter with Benjamin Graham's seminal work, The Intelligent Investor. Buffett emphasizes that within this book, particularly two key chapters, he discovered the philosophical bedrock upon which his entire investment strategy would be built. These principles, while seemingly basic, are profound in their implications and have stood the test of time. Buffett identifies three core concepts from Graham's teachings that remain central to his approach. The first fundamental principle is the crucial understanding that a stock is not merely a ticker symbol to be traded, but rather a fractional ownership stake in a real business. This perspective shifts the focus from short-term price fluctuations to the underlying economics and characteristics of the company. Buffett stresses the importance of analyzing the business itself, its industry, its competitive landscape, the quality of its management, and its long-term prospects. In his early years, Buffett admits to being fixated on ticker symbols, able to recall them for a vast number of New York Stock Exchange-listed companies. However, he lacked a true understanding of the businesses these symbols represented. Graham's teachings instilled in him the necessity of looking beyond the surface and delving into the intrinsic value of the underlying enterprise. This principle has profound implications for how an investor approaches the market. Instead of trying to predict short-term price movements, the focus shifts to understanding the long-term value creation potential of the business. This requires diligent research and analysis, akin to evaluating an entire company for potential acquisition. Investors must ask themselves, what kind of business is this? What are its strengths and weaknesses? How does it generate profits? What are its competitive advantages? By adopting this business-centric view, investors become owners rather than mere speculators. This long-term perspective fosters patience and allows investors to ride out short-term market volatility, confident in the underlying value of their holdings. The second crucial concept from Graham is the allegory of Mr. Market, a fictional business partner who daily offers to buy or sell your stake in the business at varying prices. Buffett highlights this concept from Chapter 8 of The Intelligent Investor as an unparalleled lesson in investor psychology and market behavior. Mr. Market is depicted as an emotionally volatile individual, prone to extreme optimism and pessimism. His daily price quotes are driven by his ever-shifting moods rather than by a rational assessment of the business's intrinsic value. Most investors, Buffett observes, react incorrectly to Mr. Market's pronouncements, feeling elated when prices rise and despondent when they fall, as if the market is providing instruction. However, Graham's wisdom, echoed by Buffett, lies in recognizing that Mr. Market is there to serve the investor, not to dictate their actions. His daily price offers should be viewed as opportunities rather than directives. The intelligent investor takes advantage of Mr. Market's irrationality, buying when he is overly pessimistic and selling when he is excessively optimistic. Buffett uses the analogy of owning a gas station with a partner who offers to buy or sell their share daily at different prices. In a private business setting, such erratic behavior would be a significant disadvantage. However, the public market, with its constant stream of price quotes, provides the patient and rational investor with a unique advantage. The key takeaway is to detach one's emotions from the market's fluctuations. The stock doesn't know you own it, it has no feelings about your investment. Its price movements are driven by the collective sentiment of millions of participants, often swayed by fear and greed. The intelligent investor remains objective, focusing on the underlying business value and acting only when Mr. Market presents an attractive opportunity. Buffett further emphasizes the remarkable volatility often seen in stock prices, even for fundamentally sound American businesses. He contrasts this with the relative stability in the valuations of private assets like farmland or apartment buildings. This inherent market volatility creates opportunities for those who can remain rational and disciplined. The goal is not to trade frequently but to capitalize on the occasional mispricings that Mr. Market offers. The third pillar of Graham's philosophy, and a cornerstone of Buffett's investment strategy, is the concept of a margin of safety. This principle advocates for buying assets at a significant discount to their intrinsic value to provide a buffer against errors in valuation or unforeseen negative events. Buffett illustrates this with the analogy of a bridge with a 10,000-pound capacity. A prudent driver with a 9,800-pound truck would seek a different route rather than pushing the limits. Similarly, in investing, one should not aim for precise valuations but rather seek situations where the purchase price offers a substantial cushion below the estimated intrinsic value. The margin of safety acknowledges the inherent uncertainty in forecasting future business performance and market conditions. It acts as insurance against mistakes and unexpected challenges. By buying at a discount, investors increase their potential for profit and limit their downside risk. Buffett emphasizes that one should wait for compelling opportunities where the undervaluation is significant. There is no need to force trades or chase marginal gains. The market will occasionally present situations where high-quality businesses are available at attractive prices, and these are the moments when the disciplined investor acts. Beyond Graham's foundational principles, Buffett highlights another critical element for long-term investment success, particularly when managing substantial capital: the concept of enduring competitive advantage. When considering long-term investments in private businesses, Buffett emphasizes the need to identify companies with durable advantages that protect their profitability and market share over time. He uses the metaphor of an economic castle surrounded by a wide moat. In the capitalist system, where competitors constantly seek to erode profitability, a strong moat is essential to defend against these attacks. This moat can take various forms. Patent protection, exclusive rights to a product or process can create a significant barrier to entry for competitors. Location, a strategically advantageous location can provide a sustainable edge, particularly for businesses like retail or real estate. Brand recognition, powerful brands like Coca-Cola have ingrained themselves in consumers' minds, creating a significant advantage over lesser-known competitors. Buffett notes the immense value of Coca-Cola's global brand recognition and the difficulty any competitor would face in replicating it, regardless of advertising spending. Network effects, the value of a product or service increases as more people use it. This creates a strong barrier to entry for new competitors. Cost advantages, being able to produce goods or services at a lower cost than competitors allows a company to offer more competitive pricing or enjoy higher profit margins. Switching costs, when customers face significant costs or inconvenience in switching to a competitor's product or service, it creates a strong competitive advantage. Buffett stresses that the focus should be on businesses with enduring advantages, not just those currently earning the most money. The long-term sustainability of these advantages is paramount. In addition to a strong business and a wide moat, Buffett emphasizes the importance of honest and able management. He cautions against partnering with individuals who are either unethical or incompetent. While he humorously quotes Peter Lynch's observation about investing in businesses so good that even an idiot could run them, he underscores the need for capable and trustworthy leadership. Finally, even the best business with the strongest competitive advantages is not a good investment if the price paid is too high. Buffett consistently emphasizes the need for sensible pricing. This ties back to Graham's concept of a margin of safety. Investors should seek to buy businesses at a price significantly below their intrinsic value, regardless of how attractive the company may seem. Buffett also touches upon the importance of focus and patience in investing. He recounts the analogy of a chess grandmaster who can quickly narrow down billions of possibilities to a handful of relevant options. Similarly, investors should develop the ability to quickly filter out unsuitable investment opportunities and focus their attention on the most promising ones. He suggests that instead of trying to pick the 10 best performers from a large group, it can be more effective to identify and eliminate the worst ones. This process of elimination can simplify the investment landscape and lead to better decisions. Buffett also highlights the limited number of truly exceptional investment opportunities that arise in a lifetime. He advises investors to be selective and patient, waiting for these fat pitches rather than swinging at every opportunity that comes along. He playfully suggests that investors might be better off with a metaphorical punch card with only 20 punches, forcing them to be highly deliberate with each investment decision. Furthermore, Buffett emphasizes the importance of focusing on investments that can move the needle, particularly when managing large sums of capital. Small, inconsequential investments are generally not worth the time and effort for large portfolios. Warren Buffett's investment philosophy, deeply rooted in the teachings of Benjamin Graham, offers a timeless framework for navigating the complexities of the market. By viewing stocks as ownership in businesses, understanding and leveraging market psychology, prioritizing a margin of safety, seeking enduring competitive advantages, and focusing on management quality and sensible pricing, investors can significantly increase their chances of long-term success. Buffett's enduring wisdom underscores the importance of rationality, patience, discipline, and a deep understanding of the businesses one invests in. His principles, while seemingly simple, require diligence and a long-term perspective, offering a stark contrast to the short-term speculation that often dominates the financial landscape. By embracing these core tenets, investors can move beyond the noise of the market and build a solid foundation for lasting wealth creation. We're passionate about sharing financial wisdom that empowers you. Each video takes us 20 to 25 hours to research, film, and edit with care. If our content has helped you grow, please consider making a small donation using the QR code on the screen or the link in our bio. Your support means the world to us and helps us keep going strong. Thank you.